this is one of a growing category, which is ultra-short debt ETFs that are actively managed, right? The goal here is to be boring, but then try to squeeze out a little extra yield and return by going into corporates and maybe international, right? I sometimes refer to them as money market funds with a little kick, right? So here's the $300 million. A lot of that is from the insurance company itself, but that's pretty big. 23 is pretty cheap. Mint, the big competitor, is about double, I think, somewhere in the ballpark, maybe 35. So it's on the cheaper side. Let's look at what it holds, the cross-section of it. And you can see it's not a money market fund, right? It's not just treasuries. You're going to have corporates, mortgages, right? Over here, you're going to have maybe not everything in the U.S. And then you can see the big difference of sectors in different areas. And look at here, triple B. Again, it's not all double A, right? So you're going for a little extra juice. But the duration is going for under a year. So again, not much rate risk. Let's look at the return of this one versus the two big guys in the area, Mint and Near. And you can see it's very close, although I got to give AWTM the credit. It's edging it out, probably because it has a little extra triple B. That's probably where that's coming from. So look, I mean, this is a popular area, I think, for people who look to manage cash, get a little extra yield. This will work well.
All right, still with us right now is John Orner of Aware Asset Management. There's some 16 ETFs with similar strategies, including Bill, SHV, Mint. Eric named a couple of them. Why not just put your cash in one of those ETFs instead of doing all the legwork and create your own ETF? Because that in itself costs money.
Absolutely. Well, it is a crowded area. And we just felt within the Blue Cross Blue Shield system that ultimately we could do a bit better job of this. So as Eric mentioned, there's plenty of ETFs that are in that space. There's also other products. There's money markets, there's mutual funds, there's bank deposits. So we just felt that by better executing, we can add a lot more value to that short end of the curve. We all know that that's a constrained area. We all know that that is absolutely continuing to be a challenge for short-term cash. And by doing what we do and as efficiently as we do, that's where we add the extra value.
And here's a list of the biggest actively managed short duration. This is your competition, basically. Take Mint and JPST, or let's just start with Mint. How are you different? Like, what would be the case that, what are you doing a little differently than Mint?
Well, I can't share all of our secrets, right? But I'll certainly share with you that, we're nimble, we're fleet of foot, and we're able to actually find inventory and source inventory in spaces that ultimately these organizations maybe don't even look at. So we're ultimately looking at that, we're adding additional value to each trade. You line up several of those into a portfolio, and you start to see the product that we have today.
And you're an insurance company. When I wrote this book about how institutions use ETFs, one of the things in the insurance area was that there's NAIC
Correct.
accreditation, and they were giving all fixed income ETFs like the equity tag, and therefore insurance companies had an artificial barrier to investing in them. Can you just explain if this one's like that or how things are changing on that front?
It's a great point. We have an NAIC rating of 2. And through the National Association of Insurance Commissioners, that's a really low risk charge. And so when you're managing constrained assets like we do, like most insurance companies do, keep in mind it's not just healthcare portfolios, it's life insurance portfolios, it's long-term care portfolios, it's health savings account portfolios. That extra kicker, without giving up a risk charge on the front end, allows you to save that risk budget for later, more intermediate and long-term mandates.
Now, talk a little bit overall about insurance companies and their usage of ETFs. There was a study done by Greenwich not so long ago, which found 61% of insurers plan to increase their usage of these products, of ETFs. What are insurers currently using ETFs for, and how do you see them changing that up in the coming years?
Absolutely. I think they're being used for a whole host of items across the entire investment portfolio. I think they're generally being used for placeholders, if you will, in a lot of cases. With AWTM, we're not just a buy and hold, but we're also can be used for a liquidity facility as well, given the yield component. I think that's going to change. I think investment policies through these larger organizations, insurance companies in particular, will start to accept ETFs as a very viable product in their overall investment policy itself.
Got it. So Aware spotted a problem and found a solution and brought their own assets. This is the classic case of bring your own assets.
Yeah, and I don't shame BYOA. I mean, it gives you a base, and then anything on top of that's gravy. But you were trying to be you were trying to get other people to go into it, right? You're not just like this private thing for your own insurance company, right?
Absolutely, yes. This is open to really any organization that wants to buy into AWTM. This is out there as a retail component. It's out there as an institutional investor product as well. So we plan on growing this in leaps and bounds.